Howdy, my name is Carl Dore. Welcome to the Trends and Traps for 2019 in the oil and gas services industry related to how to analyze and review and see exposure in the risk analysis world. That's what we do as attorneys. We're constantly evaluating and working with risk assessments between the credit management world and the general counsel's departments. How do those fit? How do they react? How do they handle their contracts, their reviews, their exposure? It's more than just what is the operational issues on a frac job. I'm stuck on the well and I can't get off safely and the guy's out of money. It's bigger and stranger today than that. But I think you're going to find it interesting. We have segments of virtually all the topics we could come up with that would fit your world and your interest today. Everything from how to use a petroleum engineer to analyze the complexities of the customer operator, to what do you do after a bankruptcy and they're trying to claw back and take your money back from you. I hope you enjoy it. Get ready. Thanks. Our next speaker is Tom Bett. Tom's getting mic'd up over there now. I have known Tom Bett for over 30 years. I've been an attorney for 30. Before that, we had met through Petroleum Engineering Society groups and stuff. Tom is a graduate from Texas A&M in Petroleum Engineering from 1982. He started work as a reservoir engineer, working on the largest field in Alabama. Some of you may not know, there are some giant oil fields in the Alabama area. And then he's moved to reserve economic evaluations. He formed Prater Bett in January 1999, 20 years ago, and for a purpose to do high-level reservoir evaluations for acquisition companies, bank lending, and SEC. I thought of Tom as a speaker would be perfect for an area that is not normally seen here, but we got a call for a company that was a public company in Canada that was not paying its bills. And I said, this is a public company. That can't be. Tom, can you do a check for me and see if there's any production records on these wells? What can we find out? Because I had no methodology to do that. And what he found was that there was 5 wells that were drilled. In 10 months, they made 82,000 barrels of oil. That is horrible, uneconomic, pathetically bad, uneconomic. But he also found not only that the poor performance of these wells, but that there was an article about 5 years before this last downturn that said, don't drill in this area, bad gas-oil ratio areas. So we took this information, gave it to our customer, our client, who presented it to the oil company and said, guess what? We did our job. We can't help it if your geologist picked bad locations, which they did. Go talk to your geologist, pay your bills. And they did a week later. So that's why I thought, Tom, tell us a little bit about what kind of stuff you see in petroleum engineering.
So Carl asked me to talk about the shale industry, since probably all of your companies are involved in that in some way. And whether it's economic or not, and what does that matter to you? So I'm gonna have to talk really fast today to get through this, because the real stuff is at the end that matters to y'all, but I wanted to start off with some basics and just get everybody on the same page. So, as Carl said, we've been in this business a long time. We have a consulting firm that my partner and I started in 1999. We estimate oil and gas reserves in the ground, how much they're worth, and cash flow everything out to help people like John's company. We do third-party reports, acquisitions, bank borrowing-based reviews, and some of the companies you had up there I've worked on, unfortunately. And last but not least, friends of Carl. Uh-oh.
I thought it was just me.
No. Let's try this again. Okay, I'm gonna take you through a real quick evolution of the oil and gas industry that some of y'all probably never seen. I'm gonna start from the beginning and I'm gonna end up in today. And if I can get through this slide. Okay. Way back in the early 4,000 years ago, it was found out that asphalt was actually used in the towers and walls of Babylon. And then the Chinese actually were drilling wells back in 347 AD, which is kind of unusual. But they were using the oil to burn it and then evaporate salt water to create salt. The Persians, they were digging pits in Persia in oil seep areas, and they were using that to create kerosene. And then finally we get to America in 1859, and Colonel Drake drills his first well up in Titusville, Pennsylvania. It was considered the first modern well because it was used a steam generator to actually power the drill bit. Oops, gosh darn it. Then we get to the 1900s and Spindletop was discovered in Texas. And that's just south of Beaumont on a salt dome. Then Schlumberger continued, well, they invented their first tool in 1927. And then in the 30s and 40s, the industry started drilling all these salt domes around the Gulf Coast, and then they started out in West Texas, all the easy stuff that they could find. And usually it was done on topography, and oh, there's a hill here, there must be a salt dome underneath. And so that's how it kind of started. It evolved in the 30s and 40s. In the 50s and 60s, it got a lot more sophisticated, a lot more petroleum engineering students coming out, and they started doing secondary flooding with water floods and stuff like that to get more oil out. And if you're old enough to remember, there was an oil shortage in the 70s. And so we needed more oil to be produced. And then in the 70s and 80s, they started injecting CO2 and steam and all that sort of stuff in the reservoirs to get more oil out. And that was primarily in vertical wells at that time. We started fracking wells in the 80s, primarily down in South Texas in some tight reservoirs. So I got out of school in '83, which is a long time ago. Carl got out before I did, but they were drilling vertical wells when I was at school at A&M, all around us, and they were drilling for the Austin Chalk. We saw flares everywhere around town in College Station and Bryant. Then they started drilling horizontal wells in the Austin Chalk. And the horizontal wells, they weren't fracking them, they were hoping to intersect the natural fracks in the Austin Chalk. And so that continued until that was kind of where the horizontals came from. And Burlington, if anybody remembers that name, they were one of the premier guys in the Austin Chalk. In the 90s, George Mitchell was drilling up in the Barnett Shale, which is around Fort Worth and Dallas. And they were primarily in vertical wells, but they were trying to figure out how to produce the oil from the shale. And this was, there's a whole book written on it. It's a pretty fascinating book about George Mitchell and how all that happened. But he was kind of the pioneer of the shale industry because he cracked the code to frack, stay in zones, frack those shales. Then he started drilling the horizontal wells, and there's been hundreds and thousands of wells drilled up there since then. Since that happened in the 2000s, basically up to today, we've had tremendous advances in the drilling technology and the frack technology. And many of y'all may be with some of those companies, but it has really gone fast in the last decade. So now I'm going to get you down to what is a shale. And the other thing is, a lot of the people think of shale plays. Most of the plays that are being drilled today, that some of them are shale plays, but a lot of them are just tight reservoirs with clays in them. So basically in the old days when conventional wells were drilled, they were drilled for sandstone, limestone, dolomites, vertical wells. You could produce out of these sands pretty easily. And you know, sandstone is just what it is. It's a stone made out of sand with cement in there. Shales, on the other hand, they're made out of clays and silts. And so it's very, very, when it gets compacted, there's just not much porosity. And so what it's taken and why it's so important for the horizontal wells and the fracking industry is because in order to unlock that oil and gas out of the rock, out of these tight shales, you really have to break up the rock and basically get your well to the rock and out into the formation and then crack it up. So I'm not going to belabor this, but porosity is basically the pore space in the rock. It's the void space in between the sand grains. And the permeability is how connected are those pore spaces. So in this example, the old conventional stuff is 5 to 36% porosity that can be produced, and in the shales, it's 1 to 10% porosity. And that's so you got 1% of that whole piece of rock is got pores in it. And then the permeability is really where it gets tough. Is permeability in like offshore is you measure it in darcies. Those are 1 or 2 darcies, but most of the sandstones that we deal with are anywhere from 50 to maybe 200 millidarcies. The shale plays, they're in nanodarcies. That it is like, you know, it's a millionth of a millidarcy, so it's a nanodarcy. And it's very tight, and so that's why it takes these horizontal wells, instead of contacting only 30 to 50 feet or whatever the vertical section of that rock is, you go out and you drill sideways and you can get out to 5 to 10,000 feet. So you're contacting more rock, and then you fracture it, and then you get a lot more contact to the rock that the wellbore isn't contacting. Oops. I wanted to get to that one. So this is basically where all the action is today. This is just the lower 48 states. We got shale plays all over the world. Argentina is big in them right now. But basically, these are the light tan. This is like the Gulf Coast Basin. It's where the water was way back in geologic years. This is like the Eagle Ford play is in the Gulf Coast, the Haynesville, the Tuscaloosa Marine Shale. This is the Barnett Shale play that George Mitchell did the fracking on. This is where over about 50% of the rig count is right now, in Midland Basin and Delaware Basin, all part of the total Permian Basin. You got the Bakken and Three Forks play up here in the Williston Basin, and the Marcellus in this Appalachian Basin, and Utica also. So that's kind of where most of the wells are being drilled. And I want to take you through and again, this is kind of primer here, and I'll get to the point here in a second. But so a lot of these wells in these basins, they only have one objective. You drill that one objective and you're done. In a square mile, which is a section, you may only have 4, 5, 6 wells in that horizontal section. And you go to this is an example of Midland Basin. You can't read that, but there's like the Wolfcamp A, B, C, D. You got the Upper Sprayberry, Lower Sprayberry. So you got multiple horizons that you can land your horizontal wells in. And in a square mile, this is like a cross section of that. So this is a Delaware Basin example. And here, this was a while back. They've kind of upsized this. They've changed their thoughts. But this is a example that maybe you put 7 or 8 wells in that zone. You may put 4 or 5 wells in a different zone. So you have all of these drilling pads that you see on the surface, and they may have 26 well bores going down and flaring out to the different sides. So it ends up being, I don't frankly see how they keep track of exactly where those well bores are, that they don't intersect each other, because they do cross like that underneath the ground. Very good instrumentation. So really the purpose of this whole talk is are shales economic, and what makes them economic, and why are some economic and some aren't. And I'm gonna these are simplified reasons that in my mind, this is kind of what I think about, and it's the location within the play, the price of the oil and gas, which is a big part of it, the cost to drill and complete, whether you have good rock, and whether you can recover the reserves that are in the rock. So we're going to start off with the location within the play. So this is the Eagle Ford play, and it's a little bit dated, but it's a good illustration of what's going on in the Eagle Ford. So the first well that was drilled in the Eagle Ford was about in this area right here. It was a Dora Martin well. And that well was drilled by Petrohawk. It was in what they call the dry gas, meaning that you can't get any liquids out of it. It's just, you're gonna get gas and that's it. And it had a medium BTU, heating BTU. And so that well was drilled, and that spurred the rest of the drilling and the gas, which the gas wells are indicated here in red. Well, that was back when gas prices were, I don't know, $8 to $10 a MCF. Gas price falls to $2 or $3 an MCF. Everybody bails on the dry gas and goes up here to the oil wells, and condensate wells. The oil wells are green, and the condensate are these yellow and bright green. And the reason being, it was more economic. You could get more bang for your buck for the same cost to drill a well. So, it mattered if you were, if your clients were located here, where Petrohawk drilled, or on the northern side of LaSalle County when you were in the oil and the condensate window. And that can be a matter of 20 miles. I mean, we're not talking 500 miles there. It can literally make or break you. I've got a friend that's had a ranch down there, and he asked me to look at it, and I'm like, sorry, you're 5 miles away from the good wells. I mean, that's it, and, instead of getting wealthy, he just has his ranch. So one is like, where are you because of gas and oil? The other is, how prolific are the wells? So in Midland Basin, and I started with 2015 because that's kind of as far back. Technology's changed so much since then even, but prior to that it was really different. So I took 2015 wells. So this is Midland Basin. A lot of counties, it's kind of kidney shaped. And Midland Basin since 2015 has drilled 6,117 horizontal wells. So all of those blue dots are the surface locations of those wells. And this, we pull up, we subscribe to Drilling Info, and we subscribe to this service, and it's like real-time data. We can get like, here these little drilling rigs, that's where they are located. So we can tell where the rigs are. We can zoom in on this and find the exact well and what the test results are and all the production. And so this is just an overview of it. And so I'm going to take 3 companies, and I'm going to just zoom in on those companies and do a quick analysis on them. So this is company A. All of these are real companies, and I've worked on these wells. So I took company A, and they are all located over here on the western side of the basin. I took all of their wells, which is, you can't read it, but it's about 400 wells, and I made this curve, which is what we call a time zero. So we take all their production and start in year one, and divide by the well count, and we come up with this curve. So that's the average well that Company A drilled. And then we ran economics on that, with the drilling cost, all the operating cost, kind of a normal 25% net lease, and product prices and whatnot. We come up, again, you can't read that, but it's about 350,000 barrels of recoverable oil. And then it's got like 200 or something MMCF of gas. So that was Company A on the economics. And then this is Company B. Whoops, nope, that's C. This is Company B, and they're down here in the southeast part of the Midland Basin. Did the exact same thing. Their wells are much less than that. They are, not that y'all really care, but, so they're about 200,000 barrels and 1.3 BCF. So it's a lot more gassy on this side. The wells aren't quite as good. And then you take Company C, who's drilling right here, and this is like right on the edge of the basin, where the basin's coming up like this in geologic times, and they're drilling right on the edge. And so they're thinner sands, terrible wells, 50,000 barrels, 70 MMCFs. So then we take that and we compare the companies. We say, okay, Company A, B, C, what's your economics look like? We do this all the time. These are our economic parameters: rate of return, return on investment, and payout time. You can see Company A, much better wells than Company B or C. C's like, those are just dogs. You just wouldn't drill anymore. But I need to make a point that these are, I didn't high grade any of these. This is all just like all 400 wells from Company A. Normally what we do is we high grade it. We say, okay, what exact zone are you in? How long is your lateral of your horizontal? What did you do? What year was it drilled? And all sorts of things like that. So this was just an example of 3 companies. This is another way we look at, like, we could do this for a company, but I did it for the whole 6,000 wells in Midland Basin. We get a type curve of these wells, and this type curve is like, we take all the wells drilled in 2014, 15, 16, 17, 18, and they get plotted up. And so in 2014, that well was producing started off about 400 barrels a day. Fast forward to 2018, we're almost at 900 barrels a day. And all that is technology. It's drilling technology, lateral lengths, and fracking technology. It's, they're just better than they were. There's some basins that they're getting higher rates, but they're falling faster. And so you end up in a little bit of trouble there and less reserves. This is a single well, just to show you that there are really big wells. That's about 660,000 barrels. That's daily production coming down. You started at about 1,000 barrels a day and declining out, and there's the economics right there. Much better well than any of those average companies. Okay, price of oil and gas is very important. I'm gonna run out of time if I don't speed through some of this stuff. So this is a break-even graph. Back when the price of oil was high, the break-even price was $80 to $100. Now, the break-even price in these are different basins is what that is. Break-even price is 40 to 60 dollars a barrel. And so it matters where you are. And this happens to be Bakken. I'm not gonna belabor it, but when the price of oil was very high, they were up at 200 wells were being drilled. price falls down to 50. And so you can see the companies are pulling out and when the price falls, so it really depends on what the price is. Same thing with gas. Cost to drill and complete, your company Halcon that you mentioned earlier, they were in this area. This is called the Tuscaloosa Marine Shale, and it's, EIA says it's somewhere around 7 billion barrels of oil. The problem was the cost to get it was enormous. And the cost to drill initially was $12 to $20 million, depending on what company you were listening to. And, Halcon, Goodrich, and Canna, some of them are still there, but most of them have sold out. Some of them are in trouble. Goodrich went through bankruptcy, I believe. Halcon is probably going to, or second time, right? Did they already go through? And so, anyhow, the rig count there since the oil price fell in 2014 really hasn't changed. And, producing well count, excuse me. It's been 60 ever since. They haven't been drilling any new wells. Good rock, good reserves. Again, I won't belabor that point. It's just all the things I've been talking about. Porosity, permeability, you gotta have good rock, and good reserves. So is shale economic? And why should you care about it? I'm not a credit manager, I'm a petroleum engineer, but it's very important to you guys. So my whole point is, it depends on where you are, whether it's economic or not. On pretty much everything I covered, what basin you're in, which determines what kind of product you're getting, how much it costs to drill for those wells. The oil and gas prices, that can come and go, and so you'll see drilling rig count go up and down based on that rig count. Just incidentally, there's about 4,000 wells that have been drilled and still haven't been completed. So that's a tremendous, and that's just in, I think that's just in Midland Basin, which is kind of crazy when you think about it. A lot of sunk capital. But, what is the cost to drill and complete? A lot of people don't even look at the acreage cost, infrastructure costs, but that is all in there that is whether this company is creditworthy or not. So why should you care? I'm in the service industry as a consultant, and my livelihood is dependent upon my clients paying my bill, just like y'all's company is dependent upon those clients paying their bill. Y'all do a good job of doing the client credit and looking through all that. Does it have a good banking facility? What about the creditors? The equity backers, which may end up being creditors, I guess. But, if a client drills too many uneconomic wells, especially these shale wells that are very expensive, they're gonna spiral really quick into bankruptcy. Product price is part of it, but, I can tell you right now, there's another company that's probably on your list is Alta Mesa. Alta Mesa was doing great, and then all of a sudden they got into the stack area up in Oklahoma. They started drilling wells too close to each other, spent $80 million of capital last year, and didn't get a whole lot for it. And there's a lot of backstory to that, but that's one that's probably going to be into bankruptcy, or very close, or you're going to be doing a workout with them. But so again, my whole point here and why Carl invited me to come was to show you that there are techniques that maybe your company has in-house petroleum engineers, but there are us and a bunch of big guys out there, Ryder Scott, Nolan Sewell, a whole bunch of other people that do what we do, that can pull this data up pretty quickly and determine whether or not company A is good and how are they in relationship to their competitors right nearby. And we see this all the time, like some of the smaller companies don't have the technology and they don't have the skilled professionals to drill good wells. And so they're not keeping their horizontal well in zone. Those things show up on what we're evaluating. You know, and how come this well group of wells has produced so much more reserves than the guys right next to it? It's the same rock, usually. And so, you know, we think that this is something that y'all should look at, especially if you're dealing with smaller clients. I can tell you the company C there is a very small client, and they're kind of trying to change bank facilities, and they're scrambling. And the reason is their wells are crappy. I mean, it's just y'all, none of y'all probably would lend credit to them. So that's all I had. I know it was fast. I know it was out of y'all's little area of expertise, but
I
yes.
want to go straight to one question though, so that everyone here can understand their economics is now determining whether or not they want to figure out a calculation to determine. What would you charge approximately to evaluate company C to say, here's some data, here's some results?
You know, it depends a little bit on the number of wells, but I mean, to evaluate a company like that it costs, you know, it depends on the depth of it, but maybe $5,000 to $10,000, not very much at all to check it out. And I think it's worth it. We do it every day for a living. That's just part of what we do. But it is, I think it's an important step in how y'all view creditors, really. So.